Hello everyone, I hope you all are doing very well. Here in this session, we are going to discuss Treynor ratio. It is very useful ratio for investor and you can also call it as one of the investors tool. So let's discuss about it. The Treynor ratio, also known as Treynor measure, is a financial metric which is used to evaluate the risk adjusted performance of an investment portfolio. It is named after the Jack Treynor. The ratio measures how well an investment has performed relative to its systematic risk as indicated by its beta. So ultimately it will give you that per unit risk that you have taken. So on the correspondence of per unit risk, how many percent of return you are getting? The higher Treynor ratio, it means that the better the model. If the lesser Treynor ratio, it means that the systematic investment or the portfolio is not performing that well. So what it shows, it help investors to understand about how much excess return they are receiving for each unit of risk taken. So investor, whatever they are taking the risk, on the correspondence of that, how much excess return they are expecting the receiving. So it is ultimately risk versus reward metric. Risk versus reward metric. It's particularly useful for comparing portfolios or funds that have different levels of systematic risk. A higher Treynor ratio indicates better risk adjusted return, means whatever amount of risk an investor is taking on the corresponding, the return is better. So this is Treynor's ratio reflect. We have already discussed one session on Sharpe ratio, and the Sharpe ratio basically it is also one of the financial metric, but there is a key difference between the Sharpe ratio and Treynor ratio, that is about is in Sharpe ratio it uses portfolio's standard deviation to adjust the portfolio return, whereas in tenor ratio in Treynor ratio we use systematic risk or portfolio's beta to measure the volatility. So this is the key difference, standard deviation versus beta of the portfolio between Sharpe ratio versus Treynor ratio. Now, the following is the formula of Treynor ratio, that TR equal to Treynor ratio, TR equal to Treynor ratio equal to RP minus RF divided by beta of P. So RP is return of the portfolio, RF is risk-free rate, typically the return on government bonds or in FDs, and BP is beta of the portfolio, which measures its sensitivity to market movement. Let's go through step by step example for the numerical, which is given as follows so that your understanding will be better. If the portfolio return is 12% and the risk-free rate is 3% and portfolio's beta is 1.2, then using Treynor ratio, we can calculate what is risk versus reward we are getting. So we only need to put the equation in the formula RP minus RF. So portfolio return is 12%. Subtract RF, that is risk-free rate, that is 3%. You may get that from fixed deposits or from recurring deposits or from any bonds, gold bonds or any government bond, right? Industrial bond, corporate bond. So if the data is given like that, now I am getting 9% here. And the beta of the portfolio is 1.2. So I need to divide it with 1.2. I am getting 7.5. So here tenor ratio of the portfolio is 7.5. It reflects that the portfolio is providing a return of 7.5% per unit of risk, right? Now, where we use it in real world, in performance evaluation, basically investors and the fund manager use Treynor ratio to compare the performance of different investment portfolios or mutual funds. A portfolio with a higher Treynor ratio is considered to be providing better returns per unit of risk compared to the others. And in portfolio management, it helps in making decisions about whether to invest in a particular portfolio or not. If a portfolio has a high Treynor ratio, it may be a more attractive investment because it offers higher return relative to its risk. So these returns are all about relative to the risk we are taking, right? Risk assessment. By focusing on systematic risk beta, the Treynor ratio is isolated the performance of portfolio from effect of unsystematic risk. This is particularly useful for diversified portfolios where unsystematic risk is minimized. So for risk management purpose also, many fund managers use it in the real industry. For strategic asset allocation, you know that right now there are so many or so much type of different portfolio which work on different strategies. So investor can use Treynor ratio to adjust their asset allocation by comparing different asset classes or investment strategies based on the risk adjusted return. So cumulative, it will give you better risk versus reward ratio. So in strategic asset allocation, in risk assessment, in performance evaluation, or in portfolio management, you can utilize it. So it is one of the finance metric which basically give investor risk versus the reward, and in this matrix is going to be considered, or we can consider this matrix as an investor's tool, because if investor is using this tool, then investor can just recognize that what risk is taking or what risk investor is taking in relative to the reward that he or she is expecting, right? So I hope the concept is clear. Further, you are welcome to put your suggestions that how do you like Treynor ratio and how it help you. Are you aware of this topic earlier or not? Please feel free to put your suggestions, queries, questions in the comment section, and do subscribe for more such videos. Thank you. Have a nice day. Jai Hind, Jai Bharat, and don't forget to subscribe this channel. Thank you so much.